Hey, my name is Josh. I'm a chartered accountant and I'm one of the partners at Figures. Figures is your all-in-one accounting solution, and before working at Figures or founding Figures, I worked at EY, I worked at Barclays and Crown Agents Bank. And today in this video, I'm going to show you how to move properties from your personal name into a limited company. So here's the traditional method of moving property from an individual to a company. You basically have it in your name, then you move it to a company. Now let me explain to you why this incurs a lot of tax, and there's two taxes we want to look out for. Number one, we want to look at for stamp duty, land tax, SDLT, which is here, and then also got capital gains. So in this example, your property is worth £400,000. You purchased it for 150, so now you've got a gain of 250,000. Now, capital gains tax on this is going to be £58,800. Capital gains, you get the first £3,000 is tax-free. It's very good if you're buying like a small amount of shares. But as soon as you start getting into the world of property and real estate, that £3,000 goes very quickly, as you can imagine. So this 250,000 minus 3,000, 247,000 times by 24% is a 58,800. Then we have stamp duty and land tax, which is charged on the value of the property, and it's 3%, so 19,500. And the total upfront cost, if you ought to move it from a personal to a company, is about 78,300, based on a property worth 400,000 with a gain of 250,000 pounds. So now we're on to the strategy, which is the partnership bridge. So step one, property is held in a personal name or names. So if you've got husband and wife, you're holding it as a married couple or a couple, whatever. And step two, you form a partnership, and you want to form a partnership with the same people that's holding it in step one. So if it's you're holding it with your wife, you're holding it with your husband, form a partnership with them. The reason being is because the ownership does not change hands. The same people who own the property now own them through a partnership. HMRC does not treat this as a disposal, and no stamp duty arises. So point being is that HMRC say it's the same people owning it, they're just owning it in a different structure. Now, step three. After 1 or 2 years, preferably 2 years of commercial activity, so as holding the partnership incorporates into a limited company. Now, once we go from personal to partnership, we eliminate stamp duty, land tax. Now, from step 2 to 3 is where we are now. When you incorporate from a partnership into a limited company, what happens is that the gain in your property goes into the shares. So it doesn't become payable. So let me read this through. So rather than triggering a capital gains, CGT is capital gains tax, rather than triggering a capital gains charge, any gain built up in the property from the increase in the value is transferred into the shares of the company. It stays in the shares for as long as the shares are held, and if held until death, the gain is wiped out completely. That's something to bear in mind. That if you hold it until death, the gain is wiped out. The capital gains tax only becomes payable if the shares are sold. And a good way to see this is if you bought shares in Tesla today and these shares are worth £100, if they jump up to £800 in a year's time, but you don't sell them, you haven't locked in that gain. At the same time, if the shares drop from £100 to £20 and you lose £80, you haven't lost that money until you actually sell the shares. So that the gain or the loss is not locked in until you dispose of the shares. In this case, the gain of the property is not crystallized, so it does not become payable until you sell or transfer those shares. If you've got any questions or you'd like to learn more, please feel free to reach out to me, drop me a message. There's our website, and I've also got a QR code which takes you to the website. So any questions, let me know. I'm more than happy to help, and thank you for watching the video.